Hello, welcome to CIMA.online.co.uk. My name is Samantha. In today's lesson, we are going to discuss about the financial strategy subject. The financial strategy subject is comprising of three major decisions that any business has to make, which is related to the financing decision, the dividend decisions, and the investment decisions. So as we go through today's lesson, we are going to explore each of these decisions and especially how a business is going to formulate strategies in order to effectively manage its finances. It is very important to understand the big picture of the financial strategy area. What is this big picture? The big picture is what you have to bear in your mind when you go to the exam. Why? Because when you go to the exam, you are not just another student who is coming out of school. At the exam, you are supposed to behave at a particular skill level. At the skill level, the examiners are expecting you to provide answers or solutions to particular problems. So what is the role that you have to play here? The role that you have to play here in the strategic level is as a person who is looking at the business in a holistic manner compared to the managerial level, because in the managerial level, you are just another functional manager. In many cases, you are playing the role of either a project manager or otherwise a finance manager or otherwise just an accountant. But right now, your thinking has to be elevated a little bit more in a way that you can understand the things going around in the business. Because you have studied about the performance management, financial management, and enterprise management. That means you have higher level skills acquired separately from different subject pillars. Now you come into this level where strategically you are going to look at the business, and therefore CIMA expects you to consider a combined case study tested in 3 different exams, but still it is the same case study that you are being tested on. So therefore your thinking is elevated from yet another manager into the level that you are thinking in an overall level about how the business is functioning. To give you an example, if you have to make a decision related to whether you are supposed to make a dividend payment during this year or not, you have to think about several factors. Financial factors such as whether you have enough cash availability, whether you will be able to invest into the future operations, whether you will be keeping your shareholders happy or are you going to make them unhappy. This is a non-financial factor, but it is very important when it comes to the top level of management. So as you can see, your thinking has elevated. Next, you have to think about the performance of your role. So at the examination, your answers should show that you are performing that role, where you are giving more strategic insights to the top level management. Every decision that the strategic management is taking, you will be providing relevant information in a timely and comprehensive manner that the top level management can grasp the key issues that are available in that business. So how are you going to show the top level management about these key issues? There are 3 main keywords that CIMA syllabus is taking up, namely evaluate, recommend, and advise. So for a lot of students, it is a very difficult thing to figure out what is advise, what is recommend. This is a special area that we are going to discuss in one of our tutorials. But for today, let's keep it very simple. If you are evaluating, you are trying to show the value of that particular decision, how much of a gravity that decision will bring in to the business. And then after that, you have to recommend how to do this, what to do. If you are supposed to advise, you are largely advocating on a particular area, but you are not going into that particular depth of giving how to do, what to do in detail. So if I may go into more details about what is this advice area, you will have to counsel, inform, or notify. So as you can see, it's a counseling. Your career counselor will not come with you and take you through each and every step of your exam. The career counselor will tell you, okay, your skills and your traits are more suitable to become a management accountant, so go and do CIMA. That is counseling. Inform. You are being informed. So now what you have to do is, using the available information, you are informing the top management. This is the scenario in this business. In order to avoid these problems, you have to take these actions. And thirdly, you are supposed to notify them. How are you notifying them? You will let them know that there is a problem and there should be a solution coming up. So as you can see, when you understand these words, it's very easy for you to write answers at the exam. Next we will go into the evaluate area. The evaluate area is given as appraise the value of. So as you can see, the value of that decision, what kind of influence that decision will make. So here you are not expected to just to do a pros and cons analysis, just to do a advantages, disadvantages. No, you are not supposed to do that. You will use that only as a basis of your analysis. You will look at pros and cons of the decision, but you will show in relation to the business how this will affect. And finally, recommendation. When you are supposed to recommend on something, you have to give a course of action. So as you can see on the screen right now, from the operation level to the management level and to the strategic level, you will see that the level of skills being tested. Certain skills that are at lower levels, which are related to just defining something, which are just calculating something, which are just giving pros and cons, etc. These skills are tested lesser and lesser as you go. And more testing will be done on evaluation, advice and recommendation. Now we will come into detailed discussion on what is a financial strategy. When you understand these three main decisions, it's very easy for you to do the questions. Why? Because you are starting to think like someone who has to make these decisions, or at least someone who gives meaningful insights for a top level person in order to make these decisions. What are these key decisions? Number one, financing decision. So you are running a business now. You have to figure out how to find money to run the business. So in very simple terms, how to find the money. And the consequences coming around it. Every time you use money to run a business, either from your own money or otherwise from the shareholders, which is coming under the equity category, or otherwise if you borrow under the debt category, you still have to make a payment of return. So because of this requirement, we will have something called the cost of capital. Cost of capital is a very important area discussed within this syllabus. Next you will have the investment decision. Now that you have found the money, how are you going to spend this money? Are you going to spend this money for parties? No. You are going to use this money in order to make more money. That is very important. So how are you going to make more money out of that business? You will have to invest into different kind of businesses, different kind of projects. So that in order to invest, you should analyze whether it is a viable investment or not so viable investment. And finally, let's say you have invested that money, you have gotten profits. So you have to decide to whom are you going to distribute that money. That is coming under the dividend decision. When you have earned the monies from the business, you will have to provide dividends to your equity providers. Also, you will have to consider other consequences, such as the debt providers. So you will have to maintain a fine balance between all these three areas in order to become a successful financial strategist. Now let us take a look at the syllabus content. Why are you supposed to take a look at the syllabus content? Because at home when you are studying, you know there are times that you have a little bit extra time and there are times that you will have a lot of time. So if you study what is the syllabus content, what are the weightings given into each of the areas, you will know what time you are going to spend into each of these areas. So if I take the first area, it is related to the formulation of financial strategies. As I told you, you are someone who is supporting to make decisions by the top management. When you are supporting to make the top level decisions, you should understand how the strategies are made. So that is why the first area is consisting of how are you going to create a strategy of formulating on finance area. So this first area of formulation of financial strategy consists of 25% of the syllabus coverage. Secondly, you are coming into the financing decisions. So now you can see a little bit of a direct connection between what I talked about earlier of the three main decisions that the business has to take. Investment decisions, the financing decisions and the dividend decisions. Of course, you will take into consideration about the financing decisions and the investment decisions in these first two areas, which are namely the formulation of financial strategies 25% and also another 30% of financing decisions. Next you will come into the investment decisions and project control. So as you can see, it's a very important area. Why? It's a 45% of your marks. You are supposed to get a lot of marks out of this in order to be successful at the examination. So you will have to take this into your body. It should become a daily habit. When you go out, you will see that there is a big construction going on. It should click that, okay, they should have carried out this kind of analysis. What are the factors this is affected? The external environment is affecting this, and also the internal environment is affecting this. So all these things should go through your mind every day. While you are walking, while you are in the bus, while you are on the tube, you will have to go through these things. So now you can see that in each of these areas, you cannot take it very isolatedly either. Why? Because when you are formulating the financial strategies, you have to think about all these three decisions. Because a strategic level decision maker is someone who decided on a longer term direction of a business. So when you are deciding on a longer term direction of a business, you will have to think about what are the factors that affect when you make these decisions. So when you are going to make decisions related to the long term direction of the business, you will have to consider how are you going to find the finances in a way that you can increase the value of your shareholders in the long run, which is one of the most primary objectives in any of the profit-driven organization. And then you will have to think about how are you going to distribute the dividends? How are you balancing between the interest of the business, which is needing more and more money to invest on the projects, but also the owners of the business who are demanding more and more dividends. And finally, you will have to be very thorough with the investment appraisals. Second section, the financing decisions, as I told you, is highly concentrating on how are you going to find the money using short-term, long-term, different kind of techniques, and what are the kind of ways of identifying the cost of capital. These are the concerns that you will have under the financing decisions area. What are these levels of financial strategy? If you may recall what you studied in your enterprise management subject, you remember that we learned the fundamentals of strategy formulation. Within that fundamentals of strategy formulation, you have slightly touched upon what are these different levels of strategy: corporate strategy, business strategy, and operational strategy. So as you can see, it is coming down to the board of directors level, SBU level, and the functional level. Board of directors are the top level managers, sometimes appointed by the shareholders or otherwise coming as the executive directors. The board of directors are concerned about the long-term growth of the business, the key decisions that has to be taken in order to sustain the business, in order to make sure that business is compliant with the national and international rules and regulations. And they will make these decisions if they have several other strategic business units, SBUs. After they have made these decisions, they will hand over different targets and objectives to be achieved by each of the SBUs. So the strategic business units are carrying out businesses in focused areas. For example, one of the conglomerate entities might have businesses related to clothing, business related to transportation, business related to shipping, and maybe business related to agriculture. Now in this way, the business owners and the board level ensures that the risk is distributed across different industries. So now you have to make strategies for each of these strategic business units, however, aligned with the corporate strategy. Why? Because the corporate strategy is formulated in order to make sure that the ultimate owners of the business are benefited by investing into this overall conglomerate. However, if your business does not have diversified entities, you will start the corporate strategy in the concept of long-term growth, the compliances, and the vision and mission statement level. Pass it on to the business that you are running, which is also actually a strategic business unit. And finally, it comes to the functional level. In the functional level, it makes sure that your plans and strategies are being implemented by the different levels of managers. So this is a very cascading model that are very practically used in many of the businesses. So in order to make effective financial decisions also, you are adopting this overall strategy framework. Now you can see The ultimate objective of any strategy is to maximize the wealth of the shareholders. This is for the profit-oriented firms. For all the profit-oriented firms, the ultimate objective is to maximize the wealth of shareholders. However, some of the businesses as well as organizations have other objectives also, especially in the public sector. They are concerned about the social welfare. So, your financial decisions also should be connected to the social welfare. How do you make it? Are you going to distribute free money? No. You are going to use the existing money in a way that you add value to the operation that you are running so that the general public is more benefited. Let's say, for example, National Health Service. In the National Health Service, if it is run 100% by the government will make sure that all the patients are receiving the minimal health care either without a cost or at the lowest possible cost. Now you can see that some of the countries are adopting a model which is a combination of private and public sector also. So in that case, certain health services in certain countries are running as partially public owned and partially private owned. So in that case, those entities will have to provide services with the objective of the government, and in the meantime make sure that costs are effectively managed and use some of the innovative revenue maximization strategies in order to get the revenues and the earnings to satisfy the private sector shareholders. Then there are certain non-profit oriented firms which are looking to serve a particular purpose, mission or a cause. One good example is the Adopt a Pet kind of organizations. So what they do is, because of the love for the animals, they will help the stray dogs, the stray cats to find a place to stay. So as I told you earlier also, remember, even in the profit driven firms, the other objectives, that means non-financial or non-profit oriented objectives do exist. Now let's take a look at in detail what are some of these financial objectives that the business are expecting to achieve. Investors, employees and directors, suppliers and finance providers. So these are the key stakeholder parties which are influencing the decisions of a business. Investors are always looking to achieve a profit. They invest in you because you are going to give a return more than what the bank would give by keeping a fixed deposit or otherwise a savings account. And also some of the investors would love to buy and sell the shares at a profit. So you can see that it is twofold for the investors. Either they will achieve a dividend out of it or otherwise they will achieve a capital gain out of it. Therefore, you have to balance in between both of these, and obviously you will notice that any company which is paying a healthy dividend is likely to maintain a good share price provided that all the other factors are supportive. Employees and directors. Definitely there are differences between the employees and directors in terms of the expectations, because directors sometimes they are employed, they will expect the salaries and the benefits. However, most of the directors will have an equity share also, so that they will also have an interest on the profit and dividends. In the meantime, the employees are highly focused on better salaries as well as any other non-financial benefits which are coming as different kinds of remunerations, so that they will increase their value. Then comes the suppliers who are connected to your financials, especially because they are waiting for your on-time payment. If you want to maintain a good supplier relationship, especially according to the modern management techniques in today's world, you will have to create strategic alignments with your suppliers and distribution channels. So therefore, on-time payments are very important for the suppliers to maintain those strategic links with you. And then comes the finance providers. They are always expecting timely repayments of capital and interest. They will not give you money unless they expect this. Along with the financial objectives, you are supposed to carry out a little bit of reading on what are the non-financial matters and what are the non-financial objectives that a business would have. We will go into more detail about non-financial objectives and measures in the enterprise strategy area. So right now we will take a look at when you are making financial strategic decisions, what are the things that will constrain you. These constraints mainly you can divide into internal and external factors. The internal factors are investor related, shortage of skills, or otherwise limited capacity. Why it is investor related? Because when you maintain a good investor relation, why it is investor related? Because when you maintain good investor relationships, you have to make sure that they are happy. Otherwise, they will not invest on you. So, in order to keep them happy, you will have to give them dividends. That is the expectation. Or otherwise, at least you will have to make sure that you are increasing the share price. Now, how does this become a constraint? Because when you make certain financial decisions, you know that you will have to take risky decisions which might slow down the short term earnings, but after about 5 years, the earnings will substantially grow. So, now what do? If you make that decision, the investors will be getting negative signals from your business that it is not providing a good dividend. So, therefore, the investors might sell off your shares and leave. Okay, so you have to think in terms of demand and supply theory. The very moment the shares are available for sale or put up for sale, the price will go down. Why? Because there is an increased supply compared to the demand levels. And then comes the shortage of skills. Why does this matter? Especially because in order to make very complex financial decisions, you need a lot of analysis. Also, you will need a lot of information. Let's say, for example, you are going to decide about whether you are going to invest on developing a bridge across a very long area or the span. You will have to decide whether is it viable to operate this bridge together with the government. Are you going to get the expected return by charging the tolls? What will happen if the government changes its decisions? What will happen if there is a problem with the nature? So, do you have engineers with you? Do you have non-financial analysts with you? Do you have financial analysts with you? All these factors will affect you. Sometimes even political analysis is needed. So, as you can see, if you do not have that much of internal skill base, you will definitely have challenges with making effective financial strategies. And finally, we come into limited capacity. So, let's say for example, you have these skilled people inside your business, but if they don't have the capacity, if they are either overloaded or otherwise if they are distracted with other projects, you will not have that capacity to do it. Okay, so in this way, you will notice there are several internal factors constraining effective financial strategies. Next, we come to the external factors that are constraining your effective financial strategies. First is the limited access to sources of finance. In certain countries, the stock markets are not effectively performing, so that people are not interested to invest in the stock market. And also, the banking system might not be supportive towards providing debt finance. So, in this way, there are many limitations connected to the external environment. Next will be the government influences. In certain countries, the governments are extremely friendly towards the private sector developments. However, in certain other countries, the governments are providing constraints, or otherwise, some of those governmental policies, such as imposing taxes, will hinder some of your effective financial decisions. Next comes the economic forces. Mainly, the economic forces related to the increase or decrease of interest rate, increase or decrease of the inflation rate, as well as general economic conditions in the external environment, such as availability of jobs, the level of employment. These things also will affect your financial decisions. And finally, the accounting concepts. Although not tested in depth in this syllabus, you have to remember, accounting concepts do affect to a large extent when you make some of the financial decisions. So now, coming from your previous levels of study, you are definitely supposed to revise a little bit about impact of the interest rate changes and impact of inflation changes. You will have to connect these topics with regards to what will happen to the value of the currency of the country, what will happen with regards to the investments within the country, what will happen to the prices of the goods within the country, how will it affect the employment in the country, how it is going to influence your foreign trade. These are the topics that you have to connect when you are revising about these two areas. Now we will come into the stakeholder conflicts. You will remember earlier we discussed about the importance of shareholder relations, okay, or otherwise investor relations. Always remember, shareholders are only a subset of the stakeholders. So stakeholders, generally they will have an interest about your business, and some of the stakeholders will have the ability to influence your financial and operational decisions of the business also. What is this agency theory? This explains how the businesses are managed without the day-to-day participation of the owners. So the owners will establish a business and hand it over to manage by the managers of that business. Here there is a conflict between the owners and the everyday managers because their expectations are different. The owners will always look to achieve a better profit. However, the managers, they will always try to get a better salary. You are expected to read a little bit more on this topic either in your previous level textbooks, notes, or otherwise at least on internet research. With regards to investor relations, you will notice that previously we discussed differing objectives which is related to either dividends or otherwise the increase of the share price to be sold at a profit. So there are certain investors who are looking to achieve a long-term dividend growth. Certain other shareholders would like to achieve a quick increase in the share price. So now the difficulty for the financial decision maker is, are you going to implement a project that will increase the share price in a quick manner but still not going to grow the shareholder value in the long term, or otherwise are you going to invest in a project that might not increase the share price, or otherwise sometimes unpopular decisions which might bring down the share price and finally later on will bring in the higher dividends for the shareholders. And thirdly, we come into goal congruence, which is the alignment of goals between different parties involved in the planning and decision making. So all these three areas are very important to be studied because it is coming from your previous levels and you are supposed to connect your previous levels of knowledge into the strategy.